Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Cut to the Chase. Now yesterday was the Fed meeting we were all waiting for, and it seems markets largely interpreted it as a little more hawkish than initially expected. That's what the flood of notes in my inbox this morning seems to suggest, but so did the market reaction. The S&P 500 and the Nasdaq were up about 2 to 3%, but both swung sharply into the negative after Chair Powell's comments before subsequently recovering. The 10-year US government bond yield rose above 1.85% at one point, and the dollar was stronger. Now, more than the statement, the key here was Powell's press conference. One big takeaway was that Chair Powell was non-committal on when asked whether there could be more than 4 rate hikes in 2022 or whether one of those rate hikes could be 50 basis points in size. Now, an optimist might read those comments as showing the Fed will be data dependent, but the market, though, clearly read these comments as more of a pessimist, questioning whether it meant whether more than 4 rate hikes were possible. What we found interesting, though, was Powell's comment that there was quite a bit of room to raise interest rates without threatening the labor market. Now, this is interesting because it fits into a broader view that the debate over higher rates is occurring because underlying growth is quite strong. That's important for risky assets where we're of the view that growth ultimately tends to dominate. Now, the path of interest rates, of course, dominated the discussion, and there was little new detail in the timing of a Fed balance sheet reduction. The monthly pace of new bond purchases, though, should slow further this month and likely stop by the March meeting. Now, markets might be worried about a hawkish turn, but in our view, what's equally important is the extent to which economic growth pans out in the second half of 2022. Markets are already pricing in 4 rate hikes, and while one can debate whether the final outcome will be slightly less or more than that, a slowing of growth and inflation in the second half, as we expect, could give the Fed less reason to reduce accommodation faster than what markets have already priced. This is one of the factors that gives us confidence in a positive view on risk assets on a full year basis, something we'll dig into a little more detail in our upcoming monthly to be published tomorrow. So keep an eye out for that. Now, keeping the focus on growth for a moment, we had the IMF show it's a little bit more concerned about growth than the Fed. The IMF downgraded its 2022 growth forecast by about 0.5% compared to its previous report. China and the US, of course, leading that revision lower, though India's growth forecast was revised up. What we found interesting again here, though, is that for the US, that revised number is still about 4%, and that's well above the long-term trend of about 2.5% to 3%. So in line with our view that the level of growth will still end up being at a fairly strong one. Now, moving on a little bit, what I also want to talk about was Brent oil, because we had Brent briefly rise above $90 per barrel as the tensions around Ukraine showed no signs of abating. Now, much of the talk seems to be around potential sanctions by the West on Russia in the event of an invasion, but this directly raises questions around the level to which energy prices could be affected. Recall that the way we think about the impact of geopolitics on markets is that they generally tend to lead to fairly short-lived impacts on markets unless there's a long-lasting disruption to supply. So while it's difficult to predict the exact chain of events, that's the framework we keep in mind as we interpret incoming events. Finally, before I close today's podcast, just 2 quick notes. First of all, I am taking the next 2 weeks off and attempting to get on a plane and cross borders to see family. But my colleague Abhilash will cover this podcast next 2 weeks, so please do listen in for his podcast. And second, tomorrow we'll be releasing our Through the Noise podcast, where Steve and I will dig a little bit deep into recent events and market volatility and try to step back and take a longer term perspective on what it means for markets. So please do keep an eye out for that as well. That's it for today. If you enjoyed this podcast, please don't forget to rate and like it. Thanks again for listening, and we wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.